sometimes there are reasons that you may not want to do that. So I would encourage everyone to get a combination of advice, both from myself and from their accountants. And to the extent that people don't have accountants, I work with so many wonderful accountants, some of them local, some of them not local, but with Zoom, honestly, these days, it really doesn't matter. So I've got the gambit of people, and I'm happy to make a referral of people that I deal with myself, and I have a lot of confidence and no hesitancy in referring. So I'm going to take the negative sales pitch, because I'm not trying to sell anyone an incorporation now. One of the factors against incorporating, and this is not a cost one, I'll talk about the costs in a second. One of the factors against it depends on your true qualification in terms of, or not qualification, but characterization of what you're doing employment-wise. The government recently, 2-3 years now, has cracked down on what we call incorporated employees. So those are referred to in the Income Tax Act as personal services businesses. So to the extent that, for instance, my assistant had decided that she's going to incorporate and she'd like me to pay her her company instead as a consultant and not remit payroll and so on and so forth, there's actually punitive taxation as a result of that, because the government does not want people incorporating because of some of the benefits if they're employees. Now, that doesn't prevent people who are not employees from incorporating. So really, and that's why I wanted to start above the whole incorporation conversation and what's involved in that. Really, you have to know whether or not you're a contractor or your employee. And it's not a matter of what you call yourself, because the government will always use a smell test over whatever name you put on the contract and whatever name you call yourself. They don't care about that. They'll look at certain factors to determine, are you a contractor or are you an employee? And by the way, if anyone wants me to stop at any point, if you're on mute, put your hand up, I'll stop, I'll explain it. I'm happy to have a dynamic conversation. So the tests, I wish I could tell you there's a bright line test, there isn't. But generally speaking, an employee is someone that works for one employer, unless it's kind of part-time jobs, and the employer dictates everything about the job, what they wear, when they work, how many days they have to work, how they have to do their work. The employer usually supplies all the tools. So that's what an employment job looks like. In addition, just by way of a little history, employment law used to be referred to back in the day as master-servant law. So that kind of helps you frame the understanding, at least the mindset of what an employment relationship is. Your employer tells you what to do, versus what a contractor is. So a contractor would be free to call their own shots, work their own hours. They can work as much or as little as they want. Typically, they provide their own tools. That's not always, though, necessarily a determinative factor, because a lot of hairdressers and auto mechanics may be employees, but often supply their own equipment as well. So like I said, there's no bright line test on this. There's a number of factors that go into it. Probably the best factor is having, more than one gig. So if you're not just reporting to one gig and you're doing other things and running it all through the company, that's your best bet that you are not an incorporated employee. So I believe a lot of counselors would likely be considered contractors, but the way that things are structured. But I highlight this because it is something that no one wants to walk into an adverse tax consequence. So that's something that I think is important and that you canvass with your accountants. Does that all make sense? And does anyone have any questions?
I have a question. So what if you work for a full-time agency like Fraser Health or the Ministry of Children and Family Development, and you're T Ford, but then as you work as a subcontractor, because that's a scenario. We have many employees where we would be the only agency employing them as a subcontractor, but they have another full-time job, T Ford, salaried.
Yeah, I mean, I really do think so. Like, I'd still want an accountant to vet it, but really, if you're working, 5 shifts a week or something like that, and you're calling the shots and you're providing all your tools and you've got other employment gigs. I mean, always best if you can run all these different opportunities through your company, because then that company doesn't look like a one-trick pony. But I think that that absolutely does help, Lisa. But I want to let the tax advisors advise on that for sure. I don't feel in these situations that there's a lot of risk. I think it should be explored, because I do think that we're talking about consultants, and certainly there's practice in the field that a lot of people will run their practices as consultants.
And so in our business, pretty much, I mean, the counselor is the resource, like they are the actual tool, right? But they do bring their own laptops, they do their own administration at home, they use their own printer. They may be doing stuff in the community, so they might be driving to different places. So just take that into account, because that's kind of, I think that is evidence that supports what Steve is saying, is that
Yeah.
you are, and even in the room, there's nothing in the room. You're bringing yourself and your resources into that room.
Yeah, in my view, I do think that you would all look like consultants, and I don't see this as a problem. But I do think that the personal services business is an issue that should be canvassed to ensure that you don't walk into a problem. And the reason why it's a problem is sometimes with the way the Income Tax Act works is when the government wants to dissuade you from doing something, they don't just put you in a situation that you would have been in beforehand. So you get taxed like an employee, big deal, nothing gained, nothing, nothing ventured, nothing gained. That's fine. You're not losing anything. But at the end of the day, the way personal services businesses work is you end up getting double dinged. You lose the deduction that you would as an employee, as an employer, and you're taxed as the employee. So it's kind of the worst of both worlds. So it is something to watch out for, but based on the factors and how I understand the setup, I believe you guys would be consultants, and there could be some benefit to incorporation. Often, some of the reason why why accountants will say, you might want not to incorporate until you reach a certain income level is just a cost benefit analysis. And that ties into the conversation that I mentioned earlier, and that is I talk about myself as a legal advisor, as a counselor. And I don't use the term lawyer, not because there's any reason to avoid that, because I recognize that in any decision that my clients have to make, there's a number of factors that go into it, and I'm one of them. I fit into that decision matrix, as does your accountant. And when people are doing financial planning, your financial planners and insurance brokers will also be important considerations to factor into that planning. So the legal aspect is an important aspect, but it's not the only aspect. And it'll be important for everyone to balance legal factors with other factors. So similarly, though, accountants, it'd be preferable that some of them take that same approach and say, this is not an absolute thing. I recognize that maybe your income is not quite where I would recommend the cost associated with incorporating, but there are other factors at play, and I recognize that you may want to consider those when you decide whether to incorporate or not. Lisa?
So I think where sometimes we can get into trouble as therapists, and I think there might be someone on the call that kind of experienced this and already spoke to Steve at one point, and that is where when you have an agency position and then you have a subcontractor, and then all of a sudden you made a little too much money, right? And so when you're being taxed when you bring in more revenue, then you're taxed at a higher rate. So I did a little example with Leanne this morning, because she's sort of on that cusp, is it worthwhile or not? And so you can run a bunch of different scenarios and reach out to me, and I'll help you with that, where it'll show you the amount, because I have all the numbers of what you actually made this year or last year to compare. And we can run sort of these little calculators, and we can show how much you would pay tax if you were personal versus incorporated. And so I did that little scenario with Leanne today, and she was quite surprised. And so, but again, it's on a case-by-case scenario. So feel free to reach out, and I'll show you how to run those calculations.
Right. And that's an important consideration for incorporation. And this is a conversation that I have not just with respect to incorporating, particularly if you have another job, but often for business owners who want to have multiple businesses and whether or not they want to incorporate a second company. And that decision is this. Excuse me. I've been on the phone all morning, so I've got a bit of a tickly throat. I'm going to cough. I feel fine, but no one catches anything by Zoom anyway. Um, Part of the advantage of holding money in a corporation is that you don't necessarily have to pay that money out to yourself by way of salary. So the way taxation works with a company is assuming you only have this one source of income, you have your company here and you and possibly spouses are shareholders in that company. Um, when the company makes money off of the services that are provided, the company gets taxed at the corporate tax rate. And assuming that the small business rate applies, and generally there's a test, you have to be an active business, which you would all, I believe, qualify. Then the first $500,000 in net income is taxed at a rate of, I think, 12% or just under 12%. So that is an incredibly favorable tax rate. Whereas when we put money into our genes, whether we're paid as an employee or we take money out of our company as dividends, we're going to be taxed at our marginal tax rate. And that can go as high as, I think in BC right now, 48.5, 49%. So that savings between the 12% and the top marginal rate is taxes that you're not yet paying. And to the extent that you leave them behind as retained earnings in the corporation, you're able to maybe invest those monies and have it do something else, or at the very least, even if it's sitting in a low interest bank account, you're not paying any additional taxes on it, and you're saving that nest egg for later in life. And then you can pull that out at a later time. So really that conversation is, how much money do you need? Not how much money do you want, but how much money do you need reasonably to provide for yourself and your families, to be able to make that work. And after that, if you have some discretionary spending, like you'd like to buy a boat, for instance, you have to recognize that pulling those extra funds that you have available out of the company will mean that you're going to end up paying that additional marginal tax between the 12% and whatever your marginal tax rate would be. And that'll impact your taxes next year as well.
So, for example, if this year some of us suffered because of COVID, right, or didn't work as much, or you got laid off from your other agency job, um, those funds, so that particular year, you might want to pull some of that. Or say some of you want to take maternity or paternity leave. Well, then that year, maybe you won't have made as much, so you're going to pull some of that funds that you made from the years previous and bring it into this year.
Yeah, absolutely. It helps you smooth your income and manage the tax costs. So, a lot of that comes in with figuring out, again, what you need. Just because you make it doesn't mean you want to pull it all into your personal income. So it gives you an opportunity to control that as well. Now, in terms of leaving the funds in the company, that's fantastic. But of course, I should point out that one of the reasons, so when we talk about the legal aspects and what might go into your decision matrix, whether or not you want to incorporate, is I like to talk about risk. I mean, there's the aspect of putting your money aside and smoothing your income, but I also like to talk about risk. As individuals, if we're in business and we are sued, then all of our personal assets are exposed to a lawsuit. Now, a lot of people will answer, I've got insurance, so I'm okay. And I think that's fantastic. But as I think everyone knows, and back in the day, I also used to work as an actuary. I worked for insurance companies, and the insurance companies themselves say, we're not in the business of paying out benefits. We're in the business of collecting premiums. And anytime that there is a benefit to pay out, if it's substantial, if anyone's had to deal with a car accident or a fire, our neighbor's house burnt down last fall, and reconstruction didn't start until a month or so ago because they'd been fighting with the insurance company over what's covered and what's not covered. And in the end, they didn't have a fantastic resolution, but they've got some resolution. So, we do have insurance, and that's fantastic. But I tell people also to, it depends on how risk averse you are. Incorporating adds a layer of protection between yourself and your business. You're right now,
Sorry, Steve. For us
but
as counselors, there's a pretty high risk in terms of self, like
and
anything
what I was gonna
addiction, right? Any,
Yeah, exactly. What I was going to lead into is right now the state of the counseling industry in BC, the field in BC is such that I think the regulation is not there like it is for some other professions. So, for instance, my business is incorporated for some of the reasons that we discussed, um, but the Legal Profession Act has a specific provision, as does the Accountants Act and Veterinarians Act and Health Professions Act, that says that incorporation will not shield you from personal liability. So right now there is an additional benefit, that as those acts don't apply, that you are actually shielded from liability if you provide these services through a corporation. How long that lasts, I know there's been lots of noise about regulating counselors, and harmonizing a lot of these types of services. I don't know where that's going, or where that's at right now. I've done some poking around just to try and get an indication, because I've heard noise about that forever. And I don't see a ton of traction. Maybe the people on this call have a better handle, being in the industry where things are at, but I don't think much progress has been made yet. So, so that's one of the main reasons, I think, when people need to consider incorporating, is when they can isolate themselves from personal liability. Now, it's kind of you know it's kind of an interesting dilemma, because if you leave your money in the company and the company provides the services, well, then the company would be sued. And of course, what you've earned and what you've left behind in the company would be exposed to creditors. So, having your cake and eating it too can be a very expensive venture. There is a way to do it, but unless, this whole incorporation setup really makes a lot of sense, it's not something that I'm introducing now for anyone to seriously consider. But one of the ways that businesses, where the cost justification is there, manage that particular risk is they will set up a holding corporation. So they'll have their operating company, and instead of owning it directly, they will stack a holding company that owns that operating company, and then they will own the holding company. So two layers. And then what happens is, under current Canadian tax law, intercompany dividends can be paid tax-free. So the money made in your operating company can be dividended up to your holding company and can be parked there or invested there. And then if the operating company is sued, there's no money in it. There's nothing to get. Your holding company is considered a completely separate legal entity, and as such, that money is safe from any kind of lawsuit by any claimants. So there is some mechanics to that, and that does work quite nicely. There's some tax consequences of having passive income earned in a holding company. In 2017, the Trudeau government introduced some rules that said that if you, as a business owner, have passive investment income of $50,000 or more in any year, it will eat away at your small business deduction. So that 12% that you would get, you would start to lose it, and you would lose it. It gets ground down on a punitive basis, not on a linear scale. So it's not a dollar for dollar. It's quite punitive, and it happens quite quickly. So you lose a lot of the tax advantages of saving your money. However, there's ways to manage that. Not every investment that a business owner might do. So, for instance, if you had money in your holding company, and you bought a piece of real property and you leased that out, and use those monies to pay the mortgage, you're not making any income. If you invested it in some kind of portfolio, an investment fund that doesn't pay dividends, but rather the stock price increases until you liquidate it, those are capital gains, and that won't trigger it either. So really, if you manage that properly, the passive investment rules aren't anything more than just a bit of an inconvenience in terms of what type of investment you can hold. Jeff?
Yeah, I have a question, and I apologize. I do believe we talked about this in our consult some months ago. But a company or a holding company can own assets like stocks and bonds and maybe cryptocurrency. But I'm just curious about other asset classes, like the boat, or the sports car, or something that could be legitimized as a company vehicle or something like that. Is because I know that there is corporations that offer things like company vehicles as a benefit, and I'm just curious about what makes those corporations different and what the rules are for that.
Sure. That's a good question. And a company can hold any asset class. The question is, how does that impact the use of those particular assets? How will that get taxed? So there's people who will say, we're going to hold all these assets in our corporation, and we can deduct this. I think you have to tread carefully on that. Even for me, I can't. Back when I was visiting clients and going to their offices, the only thing I can do with my vehicle, whether the company owned it or not, is expense my business expenses. And CRA has cracked down on vehicles quite seriously. And really, anyone using their vehicle for business purposes should have a log. There's lots of great apps that you can get for your phones that help you with that log, but the log should have your odometer setting at the beginning and the end of the route, and you should track it. I found a route. I haven't been audited, but I found a method that seems to work for me. My assistant will, at the end of the year, go through my calendar and track. Okay, I met a client at Brown's for lunch. The Google says it was 8 kilometers to and fro. Here's what the price is. So this is what I'm expensing. At the end of the day, the savings, at least for me, almost don't justify the cost of figuring out what it is.
So another little caveat that they do when they audit you, and I have been audited on automobile expenses a couple times. So if you are at your full-time gig at your agency and you drive from your agency to Crossroads, you can claim that. But you can't claim if you go from your house to Crossroads.
Right. Yeah. Employees, and so it goes with consultants as well. You cannot expense your travel expenses to get to your job. That's part of the costs of employment. But going from your job or from your home to your client, that's completely different. Now, CRA can get granular that way, and they could say, well, if going from your home to your client was 10 kilometers, but your office was halfway from there, then you really should only be claiming 5 kilometers to go there and not the whole. So it's a tricky thing, and it's often, really you have to look at how much tax savings you would do by running that through, and you have to look at a cost benefit analysis, because your time as counselors is incredibly valuable, and you need to think about the opportunity cost of working through all of those mechanics at the same time as the cost savings to you. So just bear with me a second.
The few voice.
Lisa knows that my wife and I share a home office, so we both have our work phones ringing through to us, and that it can sometimes get a little challenging when we're both on the call.
So in terms of expenses, guys, I actually pulled up one of my my financial reports for another company, and I went through this with Leanne, and I'm happy to go through this one-on-one with you. I don't want to share that's kind of confidential information on there. But what I showed was, what constitute office expenses, what constitutes things that, like, for example, if you are working from home office and you have paper and a printer and toilet paper and coffee and those things that you would actually use in a home office. So all those types of expenses, now you can only claim a portion of, you can claim up to 20% is sort of the safe rule. So out of all those receipts that you gather, and if you're a good receipt gatherer and keep your receipts, you'd be surprised at how much you actually use to spend to actually conduct your business. So office expenses is 20%. And so if you add those up and you compare it against the income that you're generating, those are, so let's say you have $60,000 of revenue, but you got $20,000 of receipts. Well, now you're only taxed on $40,000, right? So it's really important. So I can walk you through, like I said, I talked about the rate, and then we can talk about what your revenue actually looks like and what you think you have in terms of a monthly expenses. And then you can run those scenarios and see how that works. Back to you, Steve.
Perfect.
Another quick question.
Yeah, I mean, so there's.
Oh, sorry.
Sure.
Just to.
No, go ahead.
On assets that may not be for the business, like the boat example. Could you touch on
Right.
that? Also, I'm curious about writing off things like lunches out that are business related. How does that work?
Good questions. Yeah. So I was actually that was your original question with the vehicles and the boats, and we got waylaid on the vehicle expenses. But yeah, the idea here is a company can only expense anything that is incurred in the course of earning a profit. So, I mean, it's a pretty simple concept. So I think everyone here, you don't need to be accountants to know that. If it's not in furtherance of your business, then you can't expense it. So if you were to have a pleasure vehicle that, a boat or a car that you use, and it's not in furtherance of your business, you're likely not going to, I would advise you against trying to expense that, because you will get audited. And once you're kind of on CRA's radar screen with audits, they come back and they keep sniffing around and saying, what else can we get here? So you want to avoid it. Audits happen for no apparent reason. Sometimes it's like going through the airport. If people remember back in the day when we used to fly, you get those random, spot checks, physical checks that you have to go through. But the same thing will happen with CRA. Sometimes something flags it, and sometimes it's just, you're the next lucky contestant on Let's Get Audited. So, having a
they look for flags. So when they see big purchases and big write-offs, that'll automatically trigger it.
Yeah. And big changes. When we started our law firm, one of the things that our accountant prepared us for was that when we started filing our GST returns, we were going to be claiming input tax credits before we actually had that revenue, because of the way the billing cycle works. And they said, you're going to get audited right away. And sure enough, we got audited right away. Why you have all these claims without all this income? And, there was easy explanations for that. But there are certain things that they look at and they'll absolutely flag that. So I wouldn't hold, you can hold those assets in the company. Absolutely. You can't expense it though, because it won't be a corporate expense, which is fine. I mean, it keeps those assets separate. So you really have to think about what is the benefit and why would you hold it in the corporation, as opposed to why would you do that individually. And if it's buying the asset with, pre-personal tax dollars, which would be the reason why anyone would do that, then the use of that vehicle would be taxed as a shareholder benefit. So the government would say, well, really, you've received the benefit of this vehicle, you've received the benefit of getting this boat and using it, and here's how we're going to tax you. And I think ultimately the idea would be to put you in the same position that you would have been had you taken the funds out and done that. So
for example, though, say because you guys know I own a chalet. I own this chalet's up a big way. So if I wanted, say my chalet was in my personal name, but I decided to run a retreat, right? Bring a bunch of people up there and run the retreat. You could write off all the expenses to run the retreat, which is all the, the food and the cost and your time and that. So you can do it both ways. Like you said, you could hold it with the company, or you could own it personally, but write it off whenever you use it, or can be able to document that you brought clients there or done work there.
I have a client, got to say, he's one of my two favorite clients, the other one being on this call with us. But he's got a 120-foot yacht. We've been on it a few times and it is fantastic. He holds it within a corporation, and he actually does lease it out, usually back when they were doing the was it the Benson and Hedges fireworks, and other times he would rent it out. It would come with the full crew and food and service and all that. It's fantastic, but that's all expensable by him. His regular weekends living on the boat, that's not. So he plays some careful accounting, or he has to handle some careful accounting to make sure that he really tracks the expenses that he's writing off as a business expense, and then the personal use of that. So he effectively does have that in one of his companies, and that works nicely. He has been audited on a couple of times, and you think that maybe you don't, maybe it's just too naive, but you think that when CRA comes in and does an audit, they'll start with a reasonable position based on the facts, and then they will, you'll have to negotiate and justify adjusting their assessment accordingly. But they actually come in and they deny everything. They just assume you're a thief and you've got it all wrong and you're booking it all wrong, and now prove to me that any of this stuff is a bona fide expense. And sometimes it's harder than you think to do that. When you think about putting on an event at a chalet and all those costs, really justifying that they were used in the course of providing this event. That's just another mechanic as well. Maybe they take the approach, well, you bought a bunch of food for yourself and maybe there was some alcohol for yourself. How do we know this was just because you've got a receipt and an event? How do we know that it's an expense? So
I just went through a big GST audit, and it was really funny because you guys know the brown couches in 211, right? So those brown couches were actually, one of them is a sofa bed because it got broken up a big white, like clients broke it. But in all our chalets, we bought this same sofa bed. Like, so in 10 chalets had the same sofa bed, the same brown couches. And so then when the auditor said, well, yeah, I've seen you bought multiple couches, how do I prove that this couch wasn't for your house? And I said, well, let me show you my website here. Let's go into each chalet and you saw the same brown couch, right? And I said, and I won that one. But she actually wanted to look at my website, and her manager went through my website to make sure that those couches were there.
Yeah, and that's key, Lisa. It's justifying that and having a record of it, and it's not that easy. I talked earlier about the possibility of having spouses own your corporation. So, back to my bashing of the Trudeau government's approach to business owners, before 2017, you could have in your corporation, you could have your spouse and your adult children own shares in your corporation. And to the extent that the company paid out dividends to those people, they would all be taxed at their marginal tax rate. So it's very advantageous for business owners because sometimes the spouses may have a different income bracket, lower income bracket, or sometimes their adult children might be going to university and it might be a way of funding the tuition at their marginal tax rate, which will be almost nil. A lot of people say, well, why is that even fair? And the answer is, well, if you and your spouse bought shares of TELUS, you would each receive your income based on the dividends from that investment at your marginal tax rate. Why can't you invest in your own family business? And it seems that the small businesses are being, seriously or unfairly targeted because you can't do that anymore. Now, that said, there are exceptions to this, and this is a rule they call it the TOSI rule, which stands for tax on split income. So since 2017, the government will negatively and punitively tax business owners who improperly split income with their spouse and their children. So kiddie tax always existed. So for minors, you couldn't, since the 90s, you couldn't split income with minors. But they upped the age to 25 now. So intentionally covering off, we're not going to allow business owners help their kids with tuition, at least with corporate earned income. But there are exceptions, and some of those exceptions, and there's a long-winded tie into Lisa's story, is if the spouse either owns voting shares as well, and it's not a services business, which might actually tank all of you from being able to do this, or the spouse works in the company, and that's a different story. Now, proving that the spouse works in the company and what they do, that's a tough challenge. People will say, well, I gave them a T4. Well, that doesn't prove anything. It doesn't mean they worked. So, email logs, phone logs, proving that there's some actual work is really going to be critical. So it does tie into your decision in terms of whether or not you can income split. But I think as a services business, as a law firm, I can't do that. Although it doesn't really matter because my wife is my business partner as well. So we're both employed by the corporation and we both have the same income. So none of these things affect me directly because the government's got me left, right, and center. So, but it's the government has cracked down, I think, unfairly on professionals as well. So we are all in a group that are treated or taxed differently than a company that manufactures, car batteries. Don't know why you would distinguish between the two different types of businesses, but that's right now what the law is. So
another quick question, and thanks. This is very pertinent for me because I'm quite busy, and a big consideration for me to hire or subcontract my wife to basically just deal with emails and some accounting things as my some of my subcontracting duties. So I'm hearing that it would be critical that I have some kind of email system set up so that she has a separate email address on her phone or her computer that gets forwarded somehow, not just logging into my email on her computer. So there's more of a paper trail.
yeah.
Is there other ideas or tips or just pointers that might be helpful with that?
Yeah, I mean, I think it's an excellent thought, because if you're sharing the same email address, then how do we know it's Jeff or Jeff's wife, right? We don't know. So different email addresses for sure, and I know there's lots of different configurations where certain emails can be forwarded to another account, and accounts can be aliased and so on, and there'd be different email signatures for sure. Really log everything that you can. So to the extent, for me, it's pretty easy. Every bit of work that I do, I have a timesheet, and I record all that time. And I record, a lot of details in my timesheets. I think more so than a lot of lawyers, because I think clients want to know, they don't want to just know, email conversation with Jeff Hoy. They want to know, what did we talk about? Did you discharge me for an email? No, well, we spent a substantial amount of time figuring something out here, and this is what it is. So those timesheets do help, because really at the end of the day, to come back and really assemble that after the fact, I think a lot of people would think that's a lot of effort to save a little bit of money. But Jeff, one of the points is this whole conversation of income splitting, and it has a negative connotation, and I really don't believe it does, started years ago, where most business owners were told by their accountants, do not pay your spouse salary, because the salary really has to be reasonable. And you would have a lot of business owners who would pay their spouse $60,000 a year to do their bookkeeping, when it wouldn't cost you that with, a part-time bookkeeper who does that for a living. So that unreasonable salary was a problem. And what they did was they pointed everyone down the dividend road and say, just pay your spouse dividends on her class of shares or his class of shares, and life is good. Now, since 2017, that's changed, and people are kind of leaning back towards salary, and that's fine. But again, the salary does have to be commensurate for the most part with what they're doing. Are there little, and I don't like the negative connotation of the word cheat, but for lack of a better word, are there little cheats where you can push, the salary? If reasonable salary, let's say, might be $35,000, and you pay 40 or 42, that's probably going to fly under the radar screen, and it'll probably be a win for the family. If you pay 60, that's probably going to be something that gets flagged. So whenever you're pushing boundaries, my advice is don't get greedy.
Yeah, good to know.
Okay. Not suggesting anyone would do that, and again, not a negative connotation, but at the end of the day, this is a bit of a shell game with the government. The work is there, the effort is there. How they value it, quite honestly, Jeff, you might say, I value this work at $42,000 or $60,000, and CRI might say, no, I value it at 30. And who's to say who's right? But they hold all the power.
Yeah, they hold the trump. Yeah.
Yeah.
Sure.
Yeah.
Okay, that's good to know.
So, I mean, to your point, like we have some of our associates where they're starting to hire like their spouse or daughter or whatever just to do paperwork, because they don't want to do that paperwork. They want to be in front of the clients at $150 an hour, right? So it is pertinent that this could come into play. So just be cognizant of whatever you pay them. You have to pay them what the going rate in the market, and document that they're doing the work.
And it also helps the incorporation question as well. If there are actually other employees of the business and you're not the only employee, it also helps that conversation as well. Yes.
Hi, sorry, I have to get back. I'm on my lunch break at my other job right now. So thank you. I appreciate all the information and stuff. So thank you. And I'll be signing off now.
It's my pleasure, and I know Lisa has already circulated my contact information. I'm happy to talk to. I'm happy to talk to any of you if you have follow-up questions.
Awesome.
And Lisa, this
Thank
is being
you.
recorded, so you can just log in and continue the
Perfect.
discussion at
Awesome.
another time.
Okay.
Yes, and I have a client as well, so it was nice talking with you, Steve.
Nice to talk to you as well. Thanks for joining us.
Okay,
Thank
thank you.
All right, I'm actually going to switch back to my laptop speakers right now, just because I don't like where. Nope, scratch that. Okay. Circling back, if there's more questions, please put up your hands. Circling back to the conversation, you can see there's a lot that actually goes into the decision in terms of whether or not you want to incorporate. And as I mentioned earlier, there are certain professions, thank you. There are certain professions that incorporating won't protect you from liability. Right now, counselors have the benefit, that extra benefit of, for now it will. So running your practice through a corporation has that additional benefit over what other professions might do. And that might also be another bit of the conversation in terms of personal services business, is the government for now has not attacked incorporated lawyers, accountants, doctors, architects, other that, the list goes on and on, other incorporated professionals on the personal services businesses side of things. They realize that they've left them alone for some reason. For now, whether or not that changes when counselors are more regulated, you still may have the benefit of not really being dinged as a personal services business. So for me, I know that when the concerns over that happened, there was some conversations I had with my accountant, and a lot of people monitored the situation carefully. And my understanding now is they still leave professionals alone for now, as long as you're paying your proper taxes.
So Steve, can we talk about the GST? And I know you don't have to incorporate to have a GST number.
Right.
One of the things that if you don't have a GST number with us, you're going to have a GST number. And there's a lot of reasons I can talk about offline. But that sort of ties things in because there are, when you're writing off expenses, regardless of whether it's sole proprietor or incorporated, for everything that you pay for GST, it offsets what you collect. And sometimes it actually can put money in your pocket.
Absolutely. Yeah, and like you said, you don't have to be incorporated. If you're providing services like this and you're not an employee, you will have to charge GST. You do get those input tax credits. You won't be able to transfer your personal GST number to your business number because you're two separate entities. So the setting that up and transitioning practices from personal practice to an incorporated practice, there's some gymnastics that have to be stick handled through, but it's all doable. So just so people know, it's not a matter of just using their current GST number if they have one. Did you have a specific question, Lisa, about GST?
No, but I'm telling you all right now, if you don't have one, I'm coming after you.
You better get one. Yeah.
Because if you don't have one, and if I get audited, then I'm going to have to pay all that GST that you didn't pay. So it's really important that regardless of whether you're incorporated or not, we're going to have to make sure.
That's
right. We're supposed to be done on onboarding, but some people just didn't do it. So it's a huge risk for us too to not have that you guys registered.
So maybe if everyone still has a little bit more time, maybe I'll do a quick corporate law 101 because we didn't really talk about the construct of a company. Lisa, does that match with everyone's time? Is that okay?
Yeah, we probably. I mean, most of the counselors probably took an hour out of their schedule, so you can wrap it up in about less than 10 minutes. That'd be awesome.
I'll give it a shot. So a company is at law considered a separate legal entity. It's a separate person. That's why if we have our assets in a company and the company carries on business, our personal assets, our house, our bank accounts, they're not targeted. But corporations are basically creations of the government. So as a person, and we're all considered persons. So, all of us humans, we're at law called a person, so is a company. The law distinguishes between companies and humans by calling humans individuals. and corporations, but we're all persons. So it's a separate person, it's a separate legal identity, but because it's not a human, not an individual like us, there's different roles that people would play in bringing a company to life. One of them is the shareholder, and the shareholder are the owners of the company. Lots of different ways to describe it. I describe it as investors. Think about owning shares again in Telus or Rogers or whatever. You don't really necessarily have a lot of say in the company. You just have certain rights to perhaps dividends or distribution of capital when the shares are sold, et cetera, maybe some votes for the board of directors. So not a lot of rights as a shareholder. The shareholders elect directors. And by the way, and shareholders are immune from any liability for the most part. And the reason for that is they just own the company. They don't necessarily direct the company or do anything. They elect their directors though to run the company. They are the high level managers who direct the operations of the company. And directors actually can be personally liable for certain things. So, maybe it sounds like, well, you said I'm not liable, but now you say I am. How does that work? Directors are only liable for certain things. And what prompted me to have this quick conversation is Lisa's conversation about GST. Directors usually get on the hook for certain remittances that should be made to the government, and the company failed to do so. And if the company failed to do so, the government will go after the directors personally. So for instance, GST and EI and CPP that have to be remitted to the government. And even for your employees, you're on the hook personally for some of their salary if the company doesn't pay it. It's a capped amount. So there is some exposure for us personally when we're acting as directors of a company, but it shouldn't cause you to lose any sleep if you've got a good accountant and you're following their advice and you're remitting those taxes. People always say, as a business owner, pay yourself first. I disagree. Pay the government first, then pay yourself. And your lawyer. You pay your lawyer too. It's very important. So that's a really, really high level. Compliance. Oh, I didn't talk about costs and one-time costs and ongoing costs. We charge about all in to do an incorporation $1,500. A lot goes into what sets that up. It's not just pushing the button and incorporating the company, but we organize the company, issue the shares, create the company's minute book, and all other compliance documents that have to be established, and then prepare banking packages so that you can open your bank account and get on with business. On an ongoing basis, if the company is kept with us, we act as the registered agent. So if the company is sued, we will action that and deal with that and make sure that the service is effected properly. And then we'll also maintain your company's records on an annual basis to ensure compliance with the laws. There's forms and documents to be signed every year and filed out. Our fees, disbursements, all in cost, no surprises, is just about $400 plus or minus a little bit.
So when I first met Steve, what had happened is I had done my incorporation sort of by myself and with the help with someone who wasn't a lawyer, who represented himself as a lawyer. And so in the long run, after Steve had to correct everything for my protection, right, or for my legacy to leave this company to the kids, it cost me more probably to fix it in the long run, if I had done it properly and just left it to the lawyers. The other thing I wanted to speak to is the fact that it's quite, like, you actually have to have these incorporation documents set up to even just set a bank account. Like, you can't even imagine the work that the bank makes you to run. And if you don't have the paperwork done properly in terms of that banking package, it can delay you actually setting up these accounts. People also talk about, it's so expensive to have to use an accountant. So there's a couple of ways when you do your tax at the end of the year. You can just basically run your accounting system, your little QuickBooks or something, and you can have an account just file, and that'll only cost you a couple $100. If you want to do a full-on notice to the reader financial statements, which you might want, like for us, we do that because we want to get loans, to get lines of credit, to build offices and that. So if you're building up your business to get, say, mortgages and stuff, then you might want those financial reports, which an accountant will probably charge about $800 a year. So don't be scared off when people say, oh, if you incorporate, you have all these huge accounting charges. That's not true.
No, it's contextual. It depends on what, for people with, multiple corporations, often you see the accounting bills for the holdcos that don't have a lot of in and out transactions, a few $100s, whereas the operating company may have a lot of different things to to work through. So depending on the work that the accountants have to put in, that will dictate the costs. So I tell people often, if it comes down to the cost, at least our costs of incorporating, setting aside the accounting costs, if that's too much, then you're probably for sure not at the right point to incorporate. But I look at those costs as really $400 a year in the grand scheme of things to properly maintain your company and ensure compliance. And an example of the compliance is in 2020, the BC government brought in a new register that every corporation has to maintain, called a transparency register, and it's meant to address money laundering and proceeds of crime, and tax evasion, and so on. Running your own corporation, typically you don't end up finding out about the compliance. And a lot of our clients that we've even told that they need to comply with this, they basically said, yeah, we're not going to spend any more money and do these things, and we're not. So people should know that the penalties for individuals are $50,000 for failure to comply with that, the new regulation. So that's another advantage of having lawyers. Another advantage is if you are sued, people don't like either the process server coming to their house or their place of business, finding it embarrassing in private. So having that go to a law firm and being actioned and knowing that it's being taken care of, and someone's there to receive it, that's an advantage. Hopefully that never happens to anyone. But
it's happened to me a few times this year, Steve. But what I love about it, I mean, it sucks to get served, and you may possibly in this business get served, especially those of you on the high conflict team. That's our separation divorce team, Steve. But what I love about it is that when I open that email, because Steve's staff has got it, I know that I have a lawyer to call right away to say, what is this and what do we do with it, right? So that panic that when you receive those kind of letters, to know that you have somebody like Steve and his firm and the people that the work that they do, they'll be right there to support you, and you're not alone in it, because it's really scary to get served.
And a bigger panic can also be because you have a certain amount of time to respond to a claim. Bigger panic can be you've decided things have opened up, you're taking some time off, you're gone for a couple of weeks in the summer, and you're served, maybe right as you're leaving. You may only have, say, 7 days to respond by the time you get back, because service for a corporation is affected at its registered and records office. And if that's your home or your place of business and it's left there in compliance with the rules, then you've been served, and the clock starts running. So at a law firm, at least, maybe we know how to reach you, and we're able to say, hey, this happened. In a lot of cases, if insurance is covering it, then really you're not looking at your own lawyers defending you. You may end up going straight through your insurance company, and their lawyers will defend you. But at least that process gets kicked off, and that it's been looked at and doesn't fall through the cracks.
So I know that you guys have to run because y'all have got clients. We could probably do a part 2, but I encourage you to reach out to me or to Steve directly, and yeah, hopefully we shed some light. Is there anything else anybody wants to ask, or Steve, you want to say before we sign off?
Well, open it up to the floor to see if there's any specific questions. No. Okay. Well, yeah, I'm happy to have done this. I'm happy to do a part 2 if you guys would like that as well. If you have questions, I could do that on one-offs, or we could hop on another Zoom meeting like this, and I could answer those. Maybe send me the questions, and I can answer them, so everyone gets the benefit of those answers.
And Steve's gonna send us an email, because there's the Langley Times is doing like a vote for the best law firm. So if you guys could click on and vote for him, that'd be awesome.
That'd be awesome.
And again, Steve, I don't know. Sometimes even when there's a bunch of stuff you did for me this week, I don't know how you pulled it off, and you did. So grateful. Last minute, I reach out and you're there, and I have so much respect for this man and his firm that I highly recommend him. So, and I thank you so much for your valuable time, because I know that you pulled some strength to make this happen today.
Well, thank you, Lisa. For the votes, I'll just tell you really quickly, they make you vote in at least 10 categories. So you can't just vote for me. You have to vote for 9 other people, and you have to log off. Otherwise, they won't count the vote. So That's it. So I appreciate the push there, and I appreciate everyone's support and help on that front.
Well, thank you, everyone, and thanks to all the staff who signed on. Really appreciate it. Have a great day. And
you too.
The great work that everybody does out there.
My pleasure.
Okay, talk to you guys soon.
Okay. Enjoy the sunshine, everyone.
All right, bye.